Hey, welcome to another episode of Budget Save and Invest. I'm joined by Nero once again. Nero, how we doing?
Man, I'm well. How about you?
Yeah, can't complain. The sun's out, the weather's
Yes.
warming up.
In Sydney these days, that's a rarity, after the wet winter we had, bloody hell.
I know, I know. Um, but yeah, there's been a lot going on. I don't know
Mm,
about you. Obviously, we were talking a little bit before we started recording, but obviously business is skyrocketing at the moment. So obviously there's a
yes,
lot of investor and buying activity going on.
absolutely.
Is there anything that's come across your desk recently that you're just like, wow, that was a really good deal, or that was a really good outcome for a client that's happened recently?
Yeah, I mean, we just because of the relationships we have and everything else, some of the hotter markets like Melbourne, for example, currently is very, very hot. I'm not saying you should buy anywhere in Melbourne, but some of the markets are very, very hot. We were able to secure this deal for 30 grand below market value, and things only was worth seven fifty or so. So we got under market value. The rent came back higher. I think this client ended up getting nearly a 5% rental yield on a freestanding house in Melbourne because of how far we got the price down and what the rent came back at. And so Melbourne being a market that is traditionally very low in terms of rent return, to kind of make that happen for this client was pretty special. And the house itself was beautiful. So tick tick tick, kind of ticked all the boxes. Very, very happy client, and especially because we got them the property within like 21 days from when they enlisted us. So very happy across the board. So it's definitely hard out there, but we're able to secure some pretty special deals for clients, and some of that is it's well worth it. That's for sure.
I've had quite a few Victoria contracts come across my desk
Yes.
recently, so it's definitely hotting up.
Yes.
It's been asleep for a long time, and I feel
Yes.
like it's an early indicator that we're obviously gonna ramp up around the area, that's for sure.
Correct. Correct. Multiple areas are going to do very, very well, but typical Victoria, it's like it's a patchwork quilt kind of thing. It doesn't mean that everywhere is going to rise. There's all sorts of other issues with Victoria, like the rental yield or low land tax. So due diligence will be crucial. It's not like maybe in Sydney, where when Sydney rises, everywhere goes. Melbourne is very, very different. It's actually more diverse than most people realize who don't live in Melbourne. And so but yeah, generally speaking, there are pockets that are going to do very, very well. Because even if you look at the macro level data for Melbourne, it's actually not very strong. It's still one of the weaker performing markets, but certain segments are just going nuts for sure.
Mm. I saw your LinkedIn post the other day about Darwin. What are your I'm
Yes.
gonna have to ask you
Yes.
because there's been a lot of buyer activity in Darwin,
Yeah.
and if you were to go on realestate.com or domain.com and look in Darwin, everything is under offer
Yes.
immediately.
Yes.
You mentioned it. What are your
Mm.
thoughts on it?
Look, there is. I would expect that Darwin this year and maybe even next year might be the strongest performing capital city in terms of just raw capital growth. How much prices will rise, right? But you still couldn't pay me enough to buy in Darwin, because it's very much a boom bust kind of market. So prices rise and then they fall. And really, if you kind of look at the market, kind of see, well, what's driving it, it's very much owner occupied. Not owner occupied. It's not owner occupied. It's investors who are jumping into that market, searching for the next spot, being recommended by whoever they're being recommended that area to. The problem I have is in those kind of boom bust market, unless you know that you can time your exit perfectly. So if you've got a really good working crystal ball, that's great. But otherwise, you could end up buying a market there. It sure feels good for the next 12 months, 18 months. But then when it turns, you're stuck, right? You won't get the rental demand. You won't get that long-term capital appreciation. So while I'm not saying necessarily a bad market, I'm not saying people won't make money. You need to have the risk tolerance for it, and it's really more of a short-term play, not a longer-term play. And so for anyone looking for sort of low risk, safe investing, which is typically who we help, it's just not a market I would ever recommend based on the data that I'm seeing.
So what you're saying is we're probably going to get like a big boom up in the
Yep.
next in the short term, right? In the next 24 months, and then we're probably going to have a massive dip
Yeah.
there. So if you have the strategy to get in and get out, it could be okay, and you might make some good money. But
Yep.
if you're there for a long-term play, probably not recommended
No.
to stay there.
And I think
Um,
there'll be other places, because the thing is, if you're doing that strategy, the buy and sell, you got to take into account all your transaction costs, right? You're buying,
Mm,
selling, stamp duty, selling, capital gains, and whatever else. So when you kind of do all the numbers, I'm not sure someone actually gets that much further ahead than going with a safer long-term play that's going to keep delivering for them over the next several years. So
mm,
that's why I said raw data, sure, highest capital growth doesn't necessarily mean that an investor is going to make the most amount of money with the lowest risk. Unlikely in my books.
mm. Are there any emerging markets that you think of, whether that's like, I don't know, not necessarily a main city, but sort of outer suburbs or different areas that are outside of cities? Is there anywhere that you're seeing that's sort of on your radar?
I think, yeah. I mean, there's a couple of regional markets that I can definitely share. I think one would be Mount Gambier in South Australia. Still priced well below that magic sort of 650 mark. There aren't too many markets out there where there's hardly anything for rent at all. Really, really low supply, and it's a market that people are really wanting to move to live. It's very lifestyle driven, etc. So I'd say that's a market that while it has risen a little bit of late, it's still very in its emerging days, and also certain pockets around regional Victoria. Okay, I'm not talking about a place like Shepparton, for example, where the majority of it's flood prone or whatever else. But some of the other regional markets, like your Ballarat, for example, it's a market that's really only started to rise in value from this year. And again, you've got to be careful which pocket you're buying in. But we are starting to see some of those markets come online. But they're certainly at that what's now lower price market, which kind of 6 to 650 is really the lower end of the Australian property market. And I think a lot of these markets will kind of go past that, and will come a time potentially within 12 months or less where you don't have a budget of even 700K. You're not buying a freestanding house
Yeah.
almost anywhere unless it's a small mining town or a town with a local pub and not much else. It's just not going to be available for people. I think one of my clients said it well. He said, he's gone through a painful situation, divorce and everything else, is restarting his situation. He said he's now investing because the cost of not investing will just send him back further, right? Because
Yeah,
there's
yeah.
no way you're saving to get anywhere ahead in Australia, the way the economy's set up.
Mm. I think you're right. Like there's nothing really coming across my desk that's less than 600,000 for the
Wouldn't
moment.
surprise
So
me.
we're
Very,
getting
very.
contractor sales are coming through, and I would say really the average is around 750 to
Yep.
800 mark at the moment. What are your thoughts? So obviously, I think if we get up to that 750 bracket, which I don't think we're far off, I think you can still just about, like you say, 650 is kind of the cutoff point
Yeah.
at the moment for like a freestanding house. Um, there's a lot of talk around apartments
Yep.
at the moment because obviously you can still get an apartment in certain cities, not Sydney, because Sydney prices are
That's
are,
it, me.
are more than everywhere else. But if
Yeah.
you're looking at like a Perth or a South Australia or a Melbourne,
Yeah.
is there something to be said about, okay, we're at this price point now where it's 750 in
Yeah.
the next 12 months to 18 months time, and really you're gonna have to be earning pretty good money to get up to
Mm.
that sort of leverage mark. Um, is there going to be more incentive in the future to buy the right type of apartment?
Yes, I think you hit the nail on the head. The right type of apartment, right?
Yeah,
We,
right,
we're seeing
right, correct type of apartment.
exactly. I mean, because we're seeing this already. Like, one of our clients, had a budget only a year ago of like under 500K. We got them an apartment in Adelaide. 12 months later, it's gone up 100 grand bank valuation, right?
Mm,
And it's a
mm,
two-bedroom apartment, but it's low set. There's no supply. So I guess I'm always wary of talking about apartments. So if anyone listening, we're not talking about high rises. We're not talking about going to like the equivalent of a Westmead or a Parramatta and just seeing units everywhere. We're talking about in very low set apartment blocks where they're not building much, and also maybe the smaller capital cities. I think is where you're probably going to see not just more value but more growth because they just haven't built that many, and they're at a better price point. Yeah, but I'm not talking about Western Sydney. I'm not talking about buying in Docklands in Melbourne or whatever else where there's apartments as far as you can see. So yes, it's got to be the correct type of apartment in the correct area, and yes, you can make a great gain. And really, the only reason you're doing that is because you can't really buy a house. I still believe that if you can't afford a freestanding house in a good area, well, it's not just me. The data clearly shows that's going to outperform by a long way.
Yeah. But not to say like if it's your first property and you're going to live in it for 12 months and you're in your 20s or 30s and that's just what you can get because you've only got 30, 40K saved up. I wouldn't say it's a bad thing. Like I've done some recent really good valuations actually on, I had a client 18 months ago, moved over from New Zealand,
Yep.
moved to Western Australia, bought an apartment for, I think it was 280.
Yep.
I think it was. Like that apartment now is 475.
There you go. Yes.
That's a bloody good growth in
it's
that.
huge.
Like if you look at it on a percentage basis, God, if you'd have bought 5 or 10 of those,
exactly, right.
And make a lot of money.
Absolutely, and it's exactly what I'm saying is that those kind of apartments and those locations make a lot of sense, right? So I do think, for example, the Perth market, some of the apartments priced again sub 650, sub 600 because you don't get a house anymore for that price in Perth. There's something to be said for those apartments. It's just I don't want to take away the thing of going back to what people used to do. Is if I can't buy a house in area X, I'm going to buy an apartment there, which is very typical Sydney mindset investing or Melbourne mindset investing, and then it kind of hurts, right? Your location is still key.
Yeah, I think one thing I've talked about a lot recently with clients as well that they're probably at the point where they've built out a fairly decent portfolio. They just got no equity in their properties anymore, and they're leveraged outright. Is in the UK, I'm used to people buying houses, renovating those houses, and then going and revaluing them. I feel like it's not as common in Australia.
Yep.
And actually, we're getting to a point now where properties are getting older and tattier and a bit like they need a bit of work, right? And one of my clients called me the other day, and actually recently, I'd say in the last 3 months, I've had a lot of people say, "Hey, Ross, I want to release 50 grand because I want to upgrade one of my assets, right? It's a bit old or it's a bit whatever." And I think this is a very undervalued tool for getting equity in your property if you don't have enough to then service more property or whatever it might be. And the strategy in the UK is known as, it's not as commonly used here, but it's basically called a BRRR strategy. So it's buy, renovate, rent, refinance, repeat. And it's very common. It's very common across the UK to do that strategy. So it's buy, renovate, rent out, refinance, repeat, and you just do that. The BRRR, the BRRR strategy.
B and 4 R's, okay.
Yeah. But it's because I have a lot of expat clients. I was ex-military as well, so I get a lot of the guys that are lateral transfer and they come across, and it is I think it's definitely getting to that stage now where we're looking at different ways to build equity, and it's not just like buy a house, stick a granny flat on the back of it, do those types of models or whatever. There's a lot of other strategies that you can do, and obviously using a buyer's agent helps as well, is where you can buy land, you can buy land that's big enough, you can subdivide the land, cut off a piece of it, either sell that block of land or build on that block of land. You can also renovate your asset, create more leverage, have enough money to then go and build a granny flat at the back, which doubles your rental income. There's lots of different strategies that I think that once you get to the point where you've probably got 4 or 5 assets and you might be stuck at that leverage point, is how do I optimize my existing assets?
Yep.
Are you seeing any of this at all? Because I've got a few. It's not common. Like I find most people want to get these set and forget properties, right? But I have had a few people recently that are like, okay, I'm going to go and buy this property because it needs a bit of work. I'm going to go and do 4-6 months worth of work on it myself, and I'm going to refinance that property and then I'm going to go and buy another one.
We're not seeing it too much at this stage. What we are seeing though, rather, especially with all the new laws around each state government trying to address the housing crisis and kind of making subdivisions easier and all of that, we are starting to see some people go down that path of buying a property that meets the new zoning laws, and then really kind of subdividing and flicking off the block of land rather than doing the building themselves. So I'm seeing a bit more of that, and I've had some people reach out to me on that. So And I guess that's probably a simpler strategy because, it's just file this with if the property makes sense and meets the criteria, file the paperwork with the state government, and some of these state governments are turning things around very, very quickly. They're superseding council. So that is certainly a strategy some people are looking to do. But most people, I think, if I guess especially for my clients, they're busy. They're just kind of looking for just something to work on its own, right? And so still buying quality assets in the right area, holding it for 1, 2, 3 years, refinancing and building wealth that way. It's very passive, but it's certainly very profitable if you've got 10, 15 years, obviously, for sure.
Yeah, 100%. So let's say someone comes to you and they say, "Hi, Nero, I've got an owner-occupier property. There's a bit of equity in it. My goal in, let's say in their 40s, okay, a couple of kids, partner, and they want to get to a stage where they're making, I don't know, $150,000 a year in passive income.
Yep.
When they reach retirement, they've got 15 years to try and do that, or 15 or 20 years to try and do that. What's your sort of strategy around that?
Yeah. So first and foremost is you need to start building your foundation, which is assets that are going to grow in value and keep growing in value, right? Because everything that we spoke about just now, yes, might accelerate that or whatnot, but we need assets that are going to perform for the next 10 to 15 years, right? And then it also comes down to clients' risk tolerance. So one of the most common strategies is we might hope to buy maybe 5 properties next 10 years, have them grow in value, and then potentially flick off 2 of them, pay down the rest, and there's your rental income, right? So that's one way to do it, assuming rents are rising in those markets. Other times it is similar to what we just said: buy a property that maybe you can, it's a bigger block of land, you can subdivide the land, sell that off, pay down the debt on this property, which frees up your equity, and keep building more assets that way, right? Very rarely have I had someone come to me and say, I want to kind of add value, etc., and do that, because not that you can't, but it just at the moment in Australia with this cost of tradies and costs of works, unless you are going to do a lot of the work yourself, it's kind of somewhat cost prohibitive in many ways, right? Especially if you want that return on investment, because it's unlikely as someone who's busy in their job with a young family, etc., is then going to be able to have the time to go and do this work themselves. They want to get somebody. Trying to get tradies in lots of parts of this country is very, very difficult. So it's that renovation strategy. While we've had certain times in like my 23 investing career, I've seen certain times where there's been a boom in that activity. Right now, the shortage in that sort of industry is making things difficult. And then you've got the other issue, like Brisbane. Anyone who's got some kind of tradie-based background is working on infrastructure to do with the Olympics. So to get them to come and work on your own home, you've got to pay them those sorts of rates, which again adds to the cost. So it's just the limited pool of the people you can get. So unless you can do it yourself, it doesn't always work out as well as most people seem to think.
Yeah, it's hard to find a handyman in Australia, isn't it?
Very, very, very difficult,
Where's the local plumber that can just come around and fix something every night? It just
Exactly.
doesn't exist over here.
It doesn't exist, right? And then they're going to come at certain times or whatnot. And then if you want them to do anything major, it's but you got to wait X amount of time, and all that is costing you interest and everything else if you're doing it from an investment perspective, right? So unless you're moving into the house and can handle maybe a little bit of inconvenience, it's not always a practical strategy for most people.
Yeah. I've got some Q&A questions that I want to kind of go into from some of our Budget Save and Invest members.
Yes.
Okay, question 1. Is it worth getting into property now, or should I wait until interest rates come down further? I'm worried prices will just keep climbing if I wait. Shut.
I think this person's worries are well founded. They should listen to them. It's just, look, with interest rates falling, okay, sure, it might make your loan amount cheaper, but it makes everyone's loan amounts cheaper, and that means then you have more people bidding on this limited number of properties, which definitely drives prices up. So I think we've already seen. We haven't yet seen the data from the 3rd rate cut, although anecdotally I'm pretty certain I know what it's going to say. But at least from the first 2 rate cuts we had this year, we saw a marked increase in prices in multiple areas around the country, right? A marked increase in demand and everything else. So it's not just prices rising. It's also the fact that anyone who waits, it's going to be more and more people trying to get these properties. So it's just going to be that much harder, right? So rate cuts will actually in many ways make it harder for people if they can't already get into the market right now. If they can and they wait, it'll be harder for them.
Yeah, and I think with this October 1 announcement, it's a bit of a free for all. Like I don't know how long this scheme is going to run for.
Yeah.
I imagine they're going to look at the data after 6-12 months, and then it might get canned.
I mean,
So
either way, I think the other thing though is if you think about it, the government is guaranteeing 15% of the purchase price on these properties, which is what they're doing to help people avoid LMI. They are not going to let prices fall. Right. So
no.
if anyone who's worried that prices are where they are, and yes, they're expensive in Australia, property is not cheap in this country, they're only going to get more expensive. We had a recent announcement from the housing minister, and she said, we will not let prices fall. We want to see prices rise, but sustainably. Whatever sustainably means is up for a debate. But the government has made it very clear they do not want to see prices fall. So it's kind of like a no-brainer here that prices will rise. The extent as to how much, that'll depend on where you're buying and everything else. But prices will be higher this time next year. It's probably one of the few things you can bank on in the next 12 months.
Yeah. And I think for listeners, they need to just be aware that essentially the tax system in Australia is geared around property, right? Like 50% of the tax revenue in this country is from capital gains tax and stamp duty. There's no way that they're going to let the housing market crash or do anything. I think that's why they've been so cautious on the rate reductions compared to other countries. Like if you compare first world countries to Australia's like last, right? We've got the highest interest rates of any, and it's purely, but I think it is to try and control that. And obviously if you look at the markets recently over the last few days, they've been a bit volatile. If you're holding gold and silver in the last few days, you've done all right.
But I mean, it's what you say. It's like one of the reasons the stock market's gone all volatile is because we've seen the latest inflation data and it's getting back up to 3%. But why is it getting back up to 3%? It's for one reason only: it's housing.
Yeah.
The housing market's going up, so that's adding to the inflation issue. So yeah, it's pretty obvious that it's what you say is the reason the RBA is being cautious is because in this country it has a direct, not indirect, it's a direct, immediate impact on the housing market. That's correct. That lasts forever.
Yeah. Okay, question number 2. I've got 80k saved up. I'm renting at the moment. Am I better off buying a small investment property in a cheaper suburb using the rent vesting strategy, or should I hold out until I can afford my own home?
The short answer is we'll be going for the rent vesting strategy. The only perhaps exception to consider is if this person is on a big income and they're saving quickly, because I'm sure if you did some research, this area that they maybe want to buy their own home in, that's rising by whatever it's rising, every month. And so the question is, can you save faster than that? And most people can't. So therefore, the best strategy to be able to get into the property market and potentially get your own home down the track is to go down the rent vesting path as soon as you can, as long as you're buying an asset in an area with strong growth potential.
Yeah, I'd say the exact same, and it's just don't just go and buy something crappy though, in an area that's not going to perform well. Make sure that you buy something that's in a good performing area, but it's just cheaper than the suburb that you probably live in.
Exactly.
That's the key, really.
It's the mistake I'm seeing a lot of people make at the moment is they're desperate to get into the property market. They only have X in the bank, and so they're going and buying in areas that are really probably your C and D grade kind of areas. They're cheap, but they're going to stay cheap. They don't have the fundamentals for growth, and so just for this particular person, just do your due diligence. Buy as fast as you can, but buy in the right areas, and otherwise reach out and get the right help, because waiting will cost them for sure, and also obviously buying in the wrong area, not to say the obvious, will also cost them.
Yeah. I just recently had a client in Coffs Harbour. That's where their job role was, and they just did the whole I'm just going to buy my owner occupier. They bought a little flat in Coffs Harbour, and they're now selling it. It's like they've owned it for 7 years now. It's made no money at all. And had they just moved probably rented a house for the same price it would have cost to pay the mortgage on the flat, they could have bought in a much better suburb somewhere else and made a lot more money off it. But you just got to be cautious. I think make sure you're buying in the right area if you're going to go down the rent vesting route. Um,
100%. And Coffs Harbour is one of those markets, which what we were saying earlier on, house prices have risen. It's apartments that haven't, right?
yeah,
So it's again
exactly.
buying the right, so you just can't say an apartment, that location hasn't helped apartments grow in value. So this is
Yeah.
where, when budget is tight, getting the right help or doing the right due diligence is even more important.
Yeah. Unless you've got a one-bedroom apartment on the waterfront in Bondi, and then you probably do all right.
Well, that's fine. That's fine. But that's not 300 grand.
Yeah, you're right. That's $5 million.
Exactly. Exactly. And rising.
Yeah. Okay, last question, question number 3. Everyone talks about using equity to buy more property, but how much is too much leverage? At what point does it become risky instead of smart wealth building?
Probably more a question for yourself, Ross. It comes
Yeah,
down
I
to
think, yeah,
borrowing capacity and cash
I
flow.
think exactly. Like I've got a mixture, all sorts of spectrums of clients,
Yeah.
multi-million dollar investors and people that are just sort of starting out in the market, or people that have lost businesses and they're trying to rebuild themselves and they've got low credit scores of 120 and they're just trying to get back on their feet again. It all comes down to risk,
Yes.
really. Like, how do you feel comfortable taking on the risk?
Yeah.
I'll look at some people's bank balances and I'll go, oh, if this person takes on the risk, that's going to be fine.
Yeah.
They've got plenty of cash in the bank. Maybe they've got a large inheritance, or their owner occupier is fully paid off because they've had it for 30 years and it's done ridiculous numbers. And you can leverage to the hill and still buffer. We call it buffering. Buffer each offset account for each property, so that you might have 50 grand in each offset account to mitigate any loss that you're incurring on a monthly basis on that property. If you're starting out, I think also there's one thing, because I have a lot of single people that will contact me, right? And the unfortunate thing about being single is that you have one source of income. So I have a lot of people that will call me and they'll ask us for advice and they'll say, I want to leverage up and buy another property and da da da. And I do like to play devil's advocate in that circumstance, because I'm like, okay, well, what happens if you get made redundant in 6 months' time? What happens if you don't have enough money in your bank to cover the shortfall on these properties? Because when you're building a portfolio at the start, you are going to be if you're leveraging a lot, 80, 90% on your loan, then there is going to be a shortfall on a monthly basis. So you might be dipping in $500 to $1,000 every single month. Suddenly you get to four of those properties. It's anywhere between $2,000 and $4,000 a month. And how long can you sustain that whilst renting where you're renting, or whatever it might be? So I think it's circumstantial. Like, if you're living at home with parents, you've got no rent to pay, you can take on a bit of risk. That's fine. I think if you're in a situation where you're your only source of income and you're PAYG working for a company that could potentially go bust or get bought out by someone else and they make redundancies, then you've got to be a bit more cautious in your journey. If you're a couple, then there is a little bit more risk that you can play, right? Because if one of you gets made redundant, you still got one source of income. Or you might have parents that you could move into and you could rent the property out. There's lots of options and there's things that you can do. So there's a bit more security around that. And then obviously there's people that they're just high income earners, and actually but you'd be surprised, the higher the income, the actually less risk they want to take.
Yes, correct. That's right.
And it's always the people at the bottom that want to take all the risk.
That's it.
So in that instance, sometimes it's about actually, you got to, for some people, especially what I find is mid-level corporate, higher income earners, because you've climbed the corporate ladder, you're used to like a certain way of living, and I find that people on that trajectory tend to have a higher expense. So they've got the car, they've got the high rent, they've got kids in private school, and the expenses are high, right? So you incrementally get high pay rises as you climb up the ladder, and you incrementally start to spend more money.
Yes.
So those conversations are different, because then though in that circumstance, we'll be saying to them, hey, you've got 120 grand BMW that you're paying 3.5 grand a month on in repayments, and you've only got one asset. So you've bought an owner occupier which isn't tax deductible. You've got a car depreciating that's costing you an absolute fortune. You're earning a lot of money, but you're leveraged in all the wrong ways.
That's right.
And then it's a training and an educational conversation on, maybe we should just get rid of the 130 grand BMW, and maybe we should look at getting some more properties and things that will appreciate in value, not depreciate in value, because 3.5 grand a month on a BMW is more than my mortgages.
Yeah, exactly.
Which is crazy, right? But like, if you can buy a $700,000 asset, you'll be spending less than that BMW, and it's going to be going up in value, and it's a tax deduction if you're losing money on it as well. So leverage is a funny thing. Like, it's good if you know how to do it and you know how to use it properly, but you've got to weigh up risk versus reward, and you've got to weigh up your own personal circumstances. Do you have cash savings? Don't you have cash savings? Are you single? Are you in a couple? Are you a higher income earner, or are you building yourself up? So it's a conversation to have. What I like to do is I like to present scenarios and say, these are your options, and here's an advisor or a financial advisor or an accountant to go and discuss these options with, and then you can come back to me, and then we can amend them, and then you can work with the buyer's agent to go and source the asset, etc., etc. Anyway, that's my explanation on that one. Anything to add?
Couldn't agree more on that one. It's the risk profile itself, your cash flow. It's what's right for you. There's no real answer about what's too much or what's not enough. That's going to change based on everyone's personal circumstances.
Yeah, exactly. And even with my own portfolio, like, I could grow it quicker. I could do 10% deposits and grow it quicker. But at the moment, I've got a high rental expense, kids in daycare, which costs a fortune. Everybody knows how much it costs to have your kids in daycare in Australia. Yeah, it's like a mortgage on its own.
Exactly.
Like, I like to have a 20 grand buffer in my offset accounts, and I like to be in a position where I can put a 20% deposit down, because it just mitigates the slight loss that I'm probably going to get on rent versus mortgage repayments. But that's just my personal situation. If I wasn't paying daycare fees and the rent was cheaper in Sydney, then I might be leveraging up to 90%. So it just all depends. It all depends,
Correct.
Really.
Couldn't agree more. Everyone's situation is different, and lifestyle. Like, if your kids, once they finish child daycare and whatnot, then there might be a period of time when you can leverage up again. So. Yeah, it's also something that keeps changing over time as well.
Correct. Yeah. When the kids start working, that's when you can start risking more.
Exactly. Just not sure what price will be like by that stage, Ross.
Yeah, true. That's all right. We got family guarantee schemes for that. That's okay.
There we go.
Cool. That's a wrap for today. Thank you very much, Niro, and we'll catch you on the next episode.
See you then.